Think about the last big hotel you stayed in. A Hilton, maybe. Now here is a number that should not make sense. The Hilton company runs more than 8,400 hotels around the world. Guess how many of those buildings it actually owns? 50 out of more than 8,000, which means the company whose name is on the towel, the sign, and the little soap does not own the hotel you slept in, and it does not want to. And you assume that is just some accounting quirk. It is not. Hilton, Marriott, almost every big name you know quietly figured out that the least profitable thing you can do with a hotel is own it. So they don't. What they sell you and what they sell the person who does own the building is three completely different businesses, and not one of them is really about giving you a good night's sleep. By the end of this video, you will see the three machines hiding behind the front desk. A brand that licenses its own name for a cut of every room, at a profit margin that belongs to a software company, not a hotel. A pile of real estate owned by someone else entirely, where a private equity firm once made $14 billion on the very buildings Hilton sold off. And a loyalty program that is secretly a bank printing a currency and floating billions of your points like an interest-free loan. The room is the product they care about least. Let me show you the ones they care about most. But first, how does a hotel company end up owning almost no hotels? They did not start this way. For most of a century, hotel companies built hotels. Then they decided the building itself was the problem, and the clearest moment it happened has a date. In 1993, the Marriott Corporation, drowning in real estate debt after a property crash, split itself cleanly in two. Into one company, it put the good part, the brand, the name, the management contracts, the part that just collects fees. Into the other company, it dumped almost all the actual hotels and almost all the debt. The bankers who designed it had a private nickname for the two halves. They called them the good company and the bad company. The split was so aggressive that the people who had lent Marriott money sued. They realized the collateral behind their loans had just vanished into the other half. It was legal. It still felt like a robbery. Marriott, of course, kept the good company, and ever since, the entire industry has been running the same play. Hilton later sold the Waldorf Astoria, the most famous hotel in New York, for almost $2 billion, and on the way out signed a contract to keep operating it for the next 100 years. They gave up the building and kept the money. So start with that name over the door, because that name is the whole business. Here is how the big brands actually make money. They don't buy land or pour concrete or hire the front desk. Instead, they find a real estate investor who wants to build a hotel, and they rent them the name. The owner puts up all the money, tens or hundreds of millions, and builds the actual building. And in exchange for the Marriott or Hilton flag over the door, the owner agrees to hand the brand a slice of every dollar of room revenue forever. Usually somewhere between 4 and 6% of all room sales, right off the top. Plus more fees for marketing, the booking website, and the loyalty program. And here is the part that should bother you. That cut comes off the top line, the gross. The money before the owner has paid a single wage, a single electric bill, a single dollar of the mortgage. So the hotel can have a terrible year, it can lose money for 12 straight months, and the brand still gets paid in full on every room. It gets worse for the owner. Every few years, the brand mails them a document called a property improvement plan, and it is a renovation bill they cannot refuse. New lobby, new mattresses, new fixtures, on the brand's schedule, on the owner's money, or lose the flag. One group of hotels got hit with $40 million of these mandated renovations for a single reason. The ownership had changed hands. And if the owner ever decides they have had enough and wants to leave, they cannot just walk away. The standard penalty for breaking up with the brand early is 3 to 5 years of royalties paid in cash up front. In a single year, Hilton collected around $2.6 billion in these fees. And because it owns almost no buildings, no big staff, no real estate to maintain, that fee business runs at a profit margin around 71%. Read that again, a 71% margin. That is not a hotel margin, that is a software margin. Hilton is not a hotel company that happens to license its name. It is a licensing company that happens to be attached to hotels. But if the brand does not own the buildings, then who does? And this is where the real money quietly changes hands. The actual hotels, the physical towers of steel and rooms, are owned by a completely separate world of investors. Real estate trusts that own dozens of hotels at once and simply collect the rent. sovereign wealth funds, and above all, private equity. In fact, once you look closely, a single hotel is not one business at all. It is sliced into four. There is the brand, collecting its royalty. There is the operator, a separate company paid a fee to actually run the place. There is the investor who owns the building. And underneath all of them, sometimes there is a fourth party who owns just the land, renting the dirt to the person who owns the tower. 4 different rent checks stacked on one address, and you, the guest, are the one cash flow that feeds all 4. To these investors, a hotel is not a place to sleep. It is a machine that throws off cash, valued like any other piece of commercial real estate. And the way that works turns every little fee into something bigger. A hotel is worth its yearly profit divided by a number called the cap rate. A few years ago, at the peak, that math meant every extra dollar of profit added around $20 to the value of the building. Rates have risen since, so today it is closer to 12. But the principle is unchanged. Every resort fee, every $12 breakfast, is not just profit. It is multiplied 10 or 20 times over, straight into the price of the asset. The greatest example in history is Hilton itself. In 2007, at the absolute peak of the market, the private equity giant Blackstone bought the entire Hilton company for $26 billion, almost all of it borrowed. Weeks later, the market crashed, and on paper, Blackstone's investment was nearly wiped out. But instead of surrendering, they did something clever. They bought back Hilton's own crashed debt for pennies on the dollar, cutting billions off what the company owed. They stripped Hilton down to the asset-light fee machine, added over 1,000 new hotels without owning a single one, and then, years later, sold it all off. Their profit on the deal was around $14 billion. It has been called the most profitable buyout of all time. Sit with that. The brand went asset-light to escape the risk of owning buildings, and the firm that engineered it made $14 billion. The same hotel made 2 different empires rich, and neither of them was really selling you a room. And now the third machine, the quietest and the strangest of all, the one in your pocket, the loyalty program. You think of hotel points as a nice little perk, a way to earn a free night. The hotel company thinks of them as a currency it gets to print. Here is the trick. Those points are worth almost nothing to make, but the hotel sells them in bulk for real cash to the banks behind your credit card. Every time you swipe a hotel rewards card at the grocery store, your bank is buying points from the hotel to hand to you. One major chain is sitting on more than $7 billion of points that guests have earned, but not yet cashed in. Think about what that is. It is billions of dollars the company collected up front that it does not have to pay back until you book a room, if you ever do. It is an interest-free loan from millions of travelers who have no idea they are the lender. Most guests will never read a hotel's annual report. The whole machine is quietly built on that, and it gets deeper, because this bank has powers a normal bank can only dream of. It knows from experience that a big chunk of those points, often somewhere between 15 and 30%, will never be redeemed at all. People forget, accounts go stale. So the chains hire actuaries, the same kind of statisticians who price life insurance, to predict exactly how many of your points will quietly die. And then they book that death in advance as pure profit. There is even a friendly industry word for it, breakage. And on top of that, they get to set the exchange rate on their own money. A room that cost 50,000 points 3 years ago now quietly costs 75 or 90,000 at the exact same cash price. That is not a price change. That is inflation. On a currency they issue and you hold. And every time they do it, the billions they owe you get quietly cheaper to pay back. This is why the credit card business has become the crown jewel. Marriott alone pulled in over $700 million just from its card fees last year, and told Wall Street to expect that to jump another 35% because it renegotiated a bigger cut of every single swipe. When the pandemic hit and hotels sat empty, the big chains did not go to a normal bank. They went to their credit card partners and sold them over $1 billion of points in advance just to raise cash. A hotel chain in a crisis raised money by selling its own imaginary currency. That is not a rewards program. That is a central bank with a swimming pool. Now, in fairness, let me argue the other side because there is a real one. That flag over the door is not just a logo. A branded hotel runs on average around 3/4 full, while an independent one down the street struggles closer to 60%. because the brand brings the reservation system, the reputation, and the flood of loyalty members who only book their own chain. For the local investor who could never build that on their own, handing over a cut of revenue for all of that demand is often a genuinely good deal. The asset-light model is not a scam. It is just a very, very good business for the brand. So what could actually break a machine this clever? There is really only one thing that scares them, and it does not have a front desk at all. It is the spare room. The short-term rental. The apartment you book instead of a hotel. In just 5 years, that quiet competitor went from about a quarter of the American lodging market to nearly half, pulling millions of nights away from the traditional hotel, with no loyalty points and no resort fees. And there is trouble inside the machine too. The people who actually own the hotels are starting to revolt. A group of owners representing around 1,000 Marriott hotels recently wrote the company an angry letter because they have realized something. You now earn most of your points buying groceries, not staying in hotels, which means a guest can walk in and claim a free night on the owner's property, having never spent $1 with that owner, while the brand keeps the fat credit card fee. The innkeeper pays for the party and the bank collects the cover charge. But here's the thing. Notice what none of that actually touches. The brand still owns no buildings, so a downturn barely dents it. The real estate investors still hold the land, and the loyalty float still sits in the bank, growing. The machine was specifically designed so that when the storm comes, the pain lands on the building owner, and almost never on the name over the door. So here's the only question that actually matters, and this time I will give you the answer for free. You are now standing in front of all three businesses. The name that licenses itself, the building someone else is quietly getting rich on, and the loyalty program that is really a bank. So use it. Book direct, not through the big travel sites, and you will usually get a members-only rate the middleman never sees. Remember that the resort fee exists to make the headline price look low, so always compare the full, all-in number, and treat those points for what they are. An interest-free loan you gave the hotel that quietly loses value the longer you hold it. So spend them, do not hoard them, and aim for the sweet spots, like the 5th night that most chains give you free. The machine is beautiful, it is legal, and now you can see it. Because here is the truth of it. You were never just a guest. You are the tenant, the lender, and the customer, all three at once, and you were the only one in the building who did not know it. So on your next trip, which one of the three are you going to be? Tell me in the comments. I genuinely want to know.